Buenos días a todos, bienvenidos. Espero que estéis todos bien y bienvenidos a esta presentación del Gas Market Report, que es el del segundo cuarto del 2022, pero también hace todo el estudio a lo sucedido en el año 2021. I'm going to change to English, to switch, because we have here Jean-Baptiste Dubreuil, as all of them you know him, because he was here 3 or 4 times. Maybe this is the 5th time he's coming to introduce and to present this gas market report. Jean-Baptiste is in Paris, and now we have him in Zoom. No? This is a pleasure for having you here. As you know, he is the senior natural gas analyst, nowadays very important person in the IEA related to this situation of the markets of natural gas. I think that we thought it could be interesting to introduce or to present this gas report, because you can see the landscape in the 2021 and now the situation we have right now, the markets, the LNG market, how is dealing with that. The agency has been very active, no? So I told you before, in this area with several reports about the 10 points we need to do to reduce our dependency of the natural gas, the Russian natural gas or the other parts. And I think he knows very well all the situation on the market, the situation in Europe, but not just in Europe, in the whole world. And that's where he's going to present this report. I think you can send us, we did several times, your question and answer at the end. You can send that in the system. No? You can put that, and we at the end of the first explanation, we are going to make this Q&A session in the future. Thank you very much, Matisse. I think the floor is yours. You can introduce us in this very interesting presentation you sent us before. Jean-Baptiste, are you okay?
Muchas gracias, Arcadio. Buenos días a todos. Sorry, I'm switching quickly to English. It's a pleasure to be with you again today. To friends and colleagues from the Spanish Energy Club, to share some of the main findings on latest global gas market developments from our latest issue of the IEA's quarterly gas market report. So the report has been issued a bit less than a month ago. And as you know, things are going very, very fast these days. So we are trying to keep up to date as much as we can. But the idea here is to give you the highlights of what's been happening, not only in Europe, but more globally over the past months, and also what is our current view on the potential developments for the rest of the year, and of course, the great uncertainty that goes around those developments. So starting with something which I guess is quite familiar to everyone, is the evolution in gas prices globally. You have on this slide the changes in gas pricing over the past year for the 3 main benchmarks over the world. So Europe in light blue, Europe's TTF, the spot Asian LNG price in red, and the North American Henry Hub in dark blue. And as you can see, we've been there in this situation of very high prices and very volatile prices since the end of last year's summer. But of course, the invasion of Ukraine in late February this year triggered a new cycle of price records. We've seen all-time records being broken in the beginning of March this year. And even if prices have now lowered from those high all-time highs of March, they remain both extremely high and extremely volatile on all markets. Of course, Europe sits currently at the epicenter of the crisis, with the repercussions of the invasion of Ukraine by Russia in terms of consequences for not only for gas, but for the whole energy system, impacting and disrupting supply of oil, of coal, having repercussions on electricity. This is something that is in the front line of all European countries' press headlines in Spain, of course, among others, but in many other markets. So before going to Europe, we'd like to go very quickly to focus on what's happening outside of Europe and what are the impacts of the European situation on other prices. So first in Asia, as you can see here, you have the evolution of prices for the main benchmarks in Asia. And this has been, of course, also a price rally since September last year for all Asian gas consumers, whether it be net importers, as you can see on the top, the LNG price, the yellow curve is the spot LNG price for Japan, Korea. The JKM market has been very, very high and showing a sharp increase in the month of March. We've seen similar situations unfolding in Japan, which is the black curve, and in India, which is the red curve. The situation, of course, stems from different causes. The very tight LNG market is, of course, a reality for all gas buyers and consumers across the world. On top of that, we have other factors that further tighten the energy markets and gas markets in these countries. Very lately in India, for instance, limited availability of coal-fired generation and coal supply, on top of increased electricity needs from heat waves, has led the Indian buyers to look for additional cargoes of LNG to help balancing the Indian power market in spite of the very high prices. And this is something we also see, which might be also a bit surprising, from producing and exporting countries. So at the bottom of the slide, you can see the blue line, which is Australia's West Coast Wallumbilla spot price. And of course, if the price levels are completely different from what we see in importing countries such as Japan and India, the price trend is also going very, very steeply up. In the month of April, Australian spot prices have increased by about 60% compared to March, again, on a tight global market, and also local limitations on the availability of the coal power fleet, which has led to a massive recourse to gas-fired generation. Looking now at the other side of the market, in the United States, well, the situation, you may think that the US is practically insulated from what's happening in Europe and the consequences of the sanctions on Russia. The thing is, if we look at the evolution of US main index, the Henry Hub in the Gulf of Mexico, you see that the prices have practically doubled since February. Of course, there's the direct impact of the invasion of Ukraine, not as straightforward as in Europe or as in Asia, but it has been a combination of factors. Strong domestic demand, because we've had at the same time colder than average temperatures in the north of the US, which has prompted heating demand, and hotter than average temperatures in the south of the US, which has prompted electricity demand. At the same time, the US is also experiencing a limitation, shortages on coal stocks for power generation, which has boosted gas-fired generation in spite of those prices. Plus, of course, the United States is now a major source of LNG exports towards the global market, and the tension on this increased demand, both for the domestic market and the export market for LNG, has left to very thin supply margins, which has pushed to higher gas pipeline imports from neighboring Canada, and also massive withdrawal from the US underground storage, including during the spring month, which are usually injection months, which has led to this rally in US prices. So again, the European market really sits at the middle of the situation, but this really has global outreach and repercussions in terms of international gas markets. If we look back at how the situation evolved over the past year, last year, 2021, was an exceptional year in terms of global natural gas consumption. We've had a massive rebound in terms of consumption globally. Our estimate is 4.5% increase in 2021, just after a less than 2% decline in 2020. So that's more than doubling the recovering the losses from the COVID-induced lockdowns and the slowdown of 2020. But if we look a bit more into the details of this recovery, as you can see on the left-hand side figure, this is really a year of two halves. We have a very strong growth in the first half of the year, about 6% in Q1, above 8% in Q2. So this is really the impact of the recovery from the lockdowns. And then the second half of the year quickly slows down to about 3.5% in Q3 and around 1% in Q4 globally. So this is clearly a signal of waning of the recovery impact, also the direct impact of high prices. Those high prices have triggered slower growth in demand, some fuel switching to coal, to oil in some cases, for power generation, for industry, but also to some extent to demand destruction. This demand destruction is particularly acute in the industrial sector, which is very price sensitive. This is something that we've illustrated on the other figure on the right-hand side, where you can see a basket of major gas consuming markets. You have the United States, China, Western Europe, and India. And we've plotted the year-on-year evolution of monthly gas consumption by industrial customers. And as you can see, we have a first half of the year 2021 with a very strong increase in all markets, but mainly driven by China. And second half of the year, particularly from September on, is negative growth across all those markets. And this is really not just a question of mature markets. You see that India, China are also seeing a decline in industrial gas consumption, which is again the impact of high prices and tight supply across the global markets. Going to the supply side, for those who are familiar with the IEA publication, we regularly emphasize the strong role of liquefied natural gas trade as an enabler of diversification of supply, but also flexibility of supply in the face of security of supply threats. And of course, what has happened over the past year makes no exception to that rule. I would say that LNG, in spite of a difficult year for LNG last year because of a series of technical outages, LNG has been really instrumental in providing security of supply and flexibility of supply to the different markets. If we look at the evolution of LNG trade, that's the black line on the figure. You see that there's a strong upswing in the second half of the year, and between August and January 2022, we have about 25% increase in daily average export capacity equivalent, which mainly stems from the sharp growth in US LNG export capacity. In terms of destinations, so those are the three areas that you can see on the figure. So Asia at the bottom in blue, Europe in the middle, and other markets at the top in red. And the different shares are expressed on the left-hand side scale. And in terms of evolution, we moved from a situation beginning of 2021, which is a rather classic situation for the LNG market, where Asia tops demand at about 80% of global demand. And then we moved to a situation where seasonal Asian demand wanes to the profit of shoulder months in Europe, where it's usually used to replenish storages. And then we moved to a very tight summer LNG market. It's tight because export capacity has been declining. This is something you can see on the black line. As I mentioned, there was a series of planned and unplanned outages in LNG export capacity, which has reduced its deliverability. At the same time, Europe was caught in between Asia's summer needs and unexpected increase from other markets, which is the red area at the top of the figure. Those other markets, they're mainly South American markets. We have seen last year a record draft across South America, which has heavily impacted hydroelectricity deliverability, especially in Brazil, and which has led to much higher than expected need for LNG for power generation. So Europe was caught in the middle of those two situations in Asia and in Latin America in the middle of the summer of 2021. And from September on, as you can see, the share of Europe is continuously increasing. And now, as we look at the April figures, Europe accounts for over a third of global LNG trade in terms of imports, compared to less than 20% 9 months ago. So again, the diversification and flexibility that is provided by LNG is of primary importance in those turbulent market times. We do expect, looking at the situation, the current situation in Latin America, we do expect that the coming summer is less likely to be tensed for Latin American LNG procurement, particularly in Brazil. So this is a snapshot of Brazil's electricity, hydroelectricity and thermal electricity production capacity. So you see the light blue curve on top is hydro production capacity. It has increased substantially in beginning of 2022 compared to beginning of 2021 as the hydro reservoirs are replenishing. So as a consequence, we see that the need for thermal generation and for LNG imports by extension is expected to decline and be lower than in last year. At the same time, may still see some short-term needs for South America, particularly for Argentina, still trying to buy some short-term LNG cargoes to offset its southern winter needs to compensate for the lack of flexibility from its own domestic production. Looking at the other side of the board in terms of LNG supply, so this is the picture from the US production capacity. Last year has been a year of strong rebound in production, especially after the cold freeze of February 2021. And we've seen about 2% increase in US gas production capacity, in spite of very low level of investment, which was a result of the poor financial results that the industry made in 2020 because of the COVID. This enabled the US production to reach new all-time records in December last year, about 97 billion cubic feet per day equivalent of production. And that was able to feed the US LNG export capacity, which is expanding at a very fast pace. The situation, as we speak, since the beginning of 2022, is slowing down. As you can see, this is not something unusual. Normally, just after the peak, the winter peak, production is going into maintenance. But as I said before, the local fundamentals of US demand plus the growth of LNG export has led to some tension on the US supply, which has led to increasing recourse to Canadian pipeline imports and also to massive withdrawals from underground storage. So going back to Europe now, after this quick go around of other markets, this is the picture of the European underground storage inventory over the past gas year. And as you know, and as you can see on this picture, the Europe and UK underground storage inventory has been much lower than average over the past year from April to April. And this has strongly contributed into building up prices of gas prices at the beginning of the past summer, at the end of the injection season, and way before the outbreak of the invasion of Ukraine. The situation was at the beginning of the heating season, as you can see, that Europe and UK inventory was slightly below 80 billion cubic meters of inventory, which is more than 10 BCM below the 5-year average. And it's worth to say that a big chunk, about half of that deficit compared to the average 5-year level, was owing to lower injection in storage sites that were either owned or operated by Gazprom in Germany, in Austria, and the Netherlands. So Europe spent the whole heating season with lower than average storage capability. We ended up the heating season and started the injection season without shortages and without massive physical issues, because Europe was able to attract massive amounts of LNG, as I showed earlier, because of the price differential. Also, owing to the fact that temperatures were milder than average, which helped tempering the gas demand in Europe. So as you can see, the gas demand dropped during the gas winter compared to the previous year. This mainly owes to a temperature-sensitive demand. You can see on the left, distribution network related demand was lower because of several warm spells. We had a pretty warm beginning of the winter, particularly in December, and warmer temperatures from mid-February, which helped to lower the pressure on the demand side. This was, however, partly compensated by a rather resilient gas for power demand. In spite of the very high prices, gas for power demand was almost stagnating compared to the previous year because of lower availability from hydro and from nuclear, as you can see on the middle graph. The gap was mainly compensated by coal and by renewables, but gas was also slightly increasing compared to the previous winter. As for gas consumption in the industrial sector, so this is something I already mentioned at the beginning of the presentation. We had a steep rebound from the lockdowns in the first half of 2021, but since then, and for Q1 2022, we're seeing gas consumption levels from the industrial sectors lower than what happened in the beginning of 2021 in terms of growth. In terms of supply, the main difference, of course, was lower deliverability from Russia. And on this graph, you see the difference in terms of BCM throughout the past winter in terms of supply to Europe. And Russia, as you can see on the left, delivered about 22 BCM lower than in the previous year's winter. On top, of course, of lower availability from storages owned by Gazprom. As you know, most of the volumes which are delivered by Russia are under long-term contracts. So it's the volumes which are delivered according to those contracts, not public information. According to the information, the public information provided by Gazprom main buyers under long-term contracts, the nominations were met. So the bulk of the difference in terms of volumes comes from the previously available flexible spot volumes that Gazprom was offering to the European market that have completely disappeared at the beginning of the heating season last year. Gazprom closed its available spot volumes to the market and only delivered based on its long-term contracts. This gap in supply, as you can see, was mainly compensated by LNG, 2/3 of it coming from the United States, and to a lesser extent by additional pipeline volumes coming from Norway. Other pipeline suppliers, we've seen some balancing in between higher deliveries from Azerbaijan throughout the new Trans-Adriatic pipeline to Italy, whereas Algeria was limiting its exports with the closure of the Pedro-Duran-Farell pipeline through Morocco to Iberia, its closure end of October, and trying to ramp up through the Medgas pipeline and the Enrico Mattei pipeline to Italy. Shortly after the beginning of the invasion of Ukraine, beginning of March, the International Energy Agency issued 2 10-point plans to reduce the EU's dependence on Russian oil and Russian gas, with a series of measures that could be quickly implemented in order to lower the level of volumes imported by Russia into the European Union market. As for gas, you can see on this slide the overall picture. The sum of those actionable measures entails about 1/3 reduction of Russian gas volumes imported into the EU system. It's broken down between supply-driven measures, mainly increasing LNG imports, and to a lesser extent, increasing domestic production and pipeline imports. On the demand side, there's also a sizable contribution from existing policies in terms of both electrification, development of renewables, and energy efficiency. Additional measures with scaling up of heat pumps, temperature control, energy efficiency, and also faster development of renewables to increase the level of electricity production. One additional measure which sits at the middle of the proposition was to implement a minimum level of underground gas storage volume to provide some additional shelter against supply disruption for the coming winter. The proposition was to set a minimum of 90% filling rate for the whole of the EU. This was gradually implemented by the European Commission end of March, with a first target of 80% for the whole of the EU for the coming winter, to be scaled up to 90% for the following years. Of course, several European member countries have already implemented higher targets. So this really will be instrumental in providing additional flexibility and security of supply for the coming winter months. But at the same time, of course, increases the need for imports for the coming months in order to increase storage inventories. If we look at the additional needs in terms of injections compared to last year, that means a minimum of 13 BCM if the whole of the EU was to meet that minimum of 80% filling rate plus an additional close to 10 BCM, meeting 90%. Going back to the international context and what those changes for the European gas market entail in terms of global gas trade and global gas consumption. Our estimate for additional EU import needs as per the 10-point plan was a minimum of 25 billion cubic meters of additional imports. This appears, as we speak nowadays, a bit conservative, given the very strong increase in EU's imports. So we're currently working on a revision of those targets for the next issue of the gas market report, which is due to come in early July. But only with this conservative target of 25 BCM, you can see that we're heading for a tight global LNG market for this year, likely for the coming years. The picture is as you can see on the figure. So on the right, you have the supply additions. Our estimate is that we will have less than 30 BCM of additional LNG supply coming this year. This is the end of a cycle of new capacity addition, which were triggered by investment in new projects from 2005 on to 2014, when the oil price and gas prices collapsed. The following cycle of investment kickstarted in 17-18, but those additional capacity are not likely to materialize, in our view, before 2024, 2025, because you have to take into consideration the average lead time to develop those projects, plus additional delays which were caused by the lockdowns of 2020 and 2021. So in our view, we are going to see a very limited increase in global LNG capacity for this year and for the coming 2 years. So 30 BCM, less than 30 BCM addition in terms of LNG export for 2022. As you can see, most of it coming from the United States. We have a couple more projects outside of the US which are scheduled for this year, plus some restarts from existing LNG export plans, which are still facing technical issues. In terms of demand, Europe is expected to take the lion's share with minimum 25 BCM additional requirements, but again, likely to go beyond that. We do expect some additional volumes being picked up by China and other Asian buyers, and lower needs from other markets, particularly from South America, as again, the hydro situation is looking to improve compared to last year. But of course, any additional increase in Europe's needs will quickly translate in lower exports to Asia, and therefore additional demand destruction, because Asia doesn't have alternative supply options than LNG. What does it mean in terms of consumption? So this is the picture for global gas consumption increase forecasted for 2022, and how we have revised it since the beginning of this year. So you have two bars. The light blue bars show what we were expecting in the first issue of our report back in January, so before the invasion. And the darker blue bars show the expected growth or lack of growth for 2022, as we've published it a month ago. Again, there's a lot of uncertainty around the short to medium term trends, but one thing is certain: it will not have a positive impact on gas demand globally. We're moving from a situation where we were expecting about 1% increase for 2022 at the beginning of this year to about 0.3% decline globally for 2020. So as you can see on the left-hand side for world gas demand, that's a differential of about 50 billion cubic meters. When we look at the breakdown of this differential, most of it is coming from Asia Pacific. Because Asia Pacific is very sensitive to the balancing of the global LNG market, it is also quite sensitive to pricing. And the signals we're seeing from the Chinese market are indicating a very sharp slowdown in both LNG imports, but also in domestic consumption. This has, of course, been aggravated by the wide series of lockdowns that were induced over the past months. And there's still a strong risk of seeing more of them and having a strong impact on economic activity in China and by repercussion on China's energy consumption for this year. We have also revised further downwards consumption in Eurasia and Europe, but we're already expecting to see a negative growth this year mainly because of temperature changes. Last year, first quarter was colder than average, and this year we have seen milder than average temperatures. So even before the beginning of the invasion, it was already on a negative trend. We have also allocated some downward revisions to other markets in Africa and in Latin America and North America, but to some extent those markets are less exposed to international LNG trade, so therefore the impact is a bit less straightforward. One last point I wanted to share with you in the presentation, try to open a bit the discussion beyond gas as an energy carrier, is the wider repercussions of the conflict in terms of global economy. So on the left-hand side, you see the evolution of gas prices since January 2021, but also the evolution. The green curve shows you the evolution of urea prices. Urea is the main feedstock for all nitrogen-based fertilizers, and therefore a very important input for the agricultural world. And it's based on ammonia, which is 70% derived from natural gas globally. Of course, the evolution of high gas prices plus export restriction in ammonia and urea enacted in China and Russia over the past month has further tightened the ammonia, urea, and fertilizers market. This has had, alongside with the impact of the conflict, wider repercussions on the global economy, and this is something that you can see on the right-hand side figure. Since the beginning of the invasion, energy prices, of course, have skyrocketed, but all commodities, including food, raw materials, base metals, have seen an increasing trend. So it's likely to see that the conflict is having direct repercussions on global gas consumption, on energy consumption and prices, on price inflation, and ultimately on the global economic recovery in a post-COVID context. Thank you very much for your attention. I'm now done with the presentation. I'll be happy to engage on the discussion regarding those recent trends on our latest forecast. Thank you again.
Thank you very much, Jean-Baptiste. It's a good presentation about the crisis, about the crisis with the supply of Russia. Maybe the main issue will be the global LNG situation, because I think this last picture show very well the influence we will have in this situation with Russian supply. Do you think there's enough LNG in the world to supply Europe and to supply this crisis?
Well, the volume of LNG is as I said, is limited in terms of additional growth. We've seen some efforts being showcases both by buyers and sellers to try to increase capacity, but there will not be huge increase in the next 2 to 3 years. So as the markets gets tighter and tighter, Europe, in its position of a premium market, because European prices are above Asian prices, Europe is in a position to attract additional volumes. The uncertainty, of course, lies with the seasonal demand in Asia. We're currently, if I may say so, in a good situation in Europe, because it's the mid-season, and Europe has the advantage of having storages which can be replenished ahead of the winter, which is not the case in Asia. But Asia has a strong seasonal demand for electricity in the summer and for heating in the winter. So if we have a hot summer in Asia, and more particularly a cold winter in Asia, the competition is likely to increase.
Okay, because I only see the addiction in the States, 25 or 30 BCM. This is true, and the new additions to this market. This is the only one you show in the picture.
That's the biggest one, yes. There is a project in Mozambique, which is likely to start this year. There's also some increase in capacity, plus hopefully some restarting. For instance, Norway's export capacity is likely to restart after the accident that took place in late 2020. There's other projects which are expected to increase their capacity, but the bulk of the increase is coming from the United States.
Yeah. But because with these figures, the main exporter in the world will be the States next year or this year. It's close to Qatar or close to Australia.
Yeah, okay. Absolutely.
Okay, in 3 years or 4 years, when did it start?
Yes, years ago. It's likely to reach the 100 BCM equivalent of Qatar and Australia.
Okay, we have here several questions to you about this kind of things. Pablo, you must.
Thank you very much, Jean-Baptiste. There are a couple of questions mainly related with your presentation and also with the REPowerEU communication published in March 8th and the plan from yesterday, basically. So one of the questions is, how has the 10 plan to reduce EU's reliance on Russian gas, how is it related to the REPowerEU plan? If all 10 points have taken into account, I know that you mentioned concerning storage, that you established or you recommended a 90% storage capacity filled up. The EU said 80%. And also another question is, do you see this feasible to be able to have these storage levels for the month of November, which I think is the date to have it? Yeah.
Yeah, thanks a lot, Pablo. Well, first, the 10-point plan was issued slightly before the first REPowerEU communication, but we're working. The IA is working in close cooperation with the Commission, and actually the 10-point plan was jointly presented by our executive director and the Energy Commissioner, Mrs. Simpson. So this is a joint work that we're pursuing. And we're fully supporting the Commission in its evaluation of the different measures, which of course will have to be translated and implemented by the different member states. As I mentioned, the Commission has set an intermediate level of 80% filling rates for storage for the coming winter, which is scaling up to 90% for the winter of 2023. But several member countries have already moved to higher than 80% rates. As for the capability of filling the storage, again, I think that when we're looking at the current injection rates, it's increasing very fast, again, in spite of the high prices. The ability for Europe to capture additional volumes, of course, depend on the global competition on the LNG market and the risks of further disruption from Russia.
Okay. There's another question concerning the 10-point plan, and it says in Action 6 has to do with applying short-term measures to shelter vulnerable electricity consumers from high prices. And they're asking you, from your view, how can this be done?
Well, there are some short-term exceptional measures that can be enacted. I think that have already been discussed or implemented in certain member states, such as Spain, for instance, with the cap on price of gas, momentary cap on the price of gas for power generation. It could also be through exceptional taxes for windfall profit from certain industrial companies, but all those measures have to be temporary and targeted to make sure that they provide short-term relief to those who are particularly exposed to energy access and energy prices, and try as much as possible not to distort the market signals and resulting in higher energy consumption in times of high prices and tight markets.
Okay. They're asking also your opinion on the possibility that it was opened yesterday in the plan of establishing a maximum price for gas at European level in case of an interruption of gas flow. What's your view on this issue?
Well, again, this is something that has been put in place in several member states to put a ceiling on gas prices, especially for the winter season. There's a similar mechanism in France. I know that other countries also put that in place, either for specific types of consumers, mainly for households, for instance. Again, the idea is to smooth the economic impact, but at the same time it has to be balanced to make sure that there is still, it's still borne in mind that consumers need to be protected, but they have to be aware that energy efficiency is the most efficient, if I may say, way of tackling high prices and shortages. So this is why one of the measures includes individual actions such as lowering heating temperatures, which can be actioned by each and every consumer at its own individual level to alleviate the tension on global gas consumption.
Okay, Arcadio, you have a question.
I have a question for you about the floating LNG and the capacity we have in Europe to regasification plants, no? Because I understand this is very difficult to build a new tanks and new projects offshore. What is the situation? Because sometimes in your report you analyze the risks, no? The risks in the States for something. But what do you think about that? What is your view of this floating LNG could be a solution, no? For that.
Yeah, well, the current European LNG capacity is not yet maxed out, but it's been used very extensively. Several member countries have resorted to and private companies resorted to plans to hire or build floating regasification units, which are a solution to fast track the development of additional LNG import capacity. This is something that's been proven in the past in countries such as Egypt or Argentina or Brazil, or Chile, for instance, which were faced with sudden supply shortages. It enabled to, in a limited amount of time, to enable additional volumes. So there's already several projects in the pipeline, but those, of course, are mid-time measures to bridge the gap.
Okay. There's a question in the chat that's also asking you if you can comment on the flexibility and capacity that Russia has to send gas to China, gas which is not sent to Europe.
Yeah, that's one of the points that Russia's been very vocal to in the past months. Technically speaking, there's no arbitrage capacity in between Europe and China for Russian gas, because the fields that are used to send to Europe are located at the western end of Siberia. They're not connected to the eastern Siberia fields, which are delivering to China. So it will take several years. I'm not an expert in building pipelines in the permafrost in the middle of Russia, but it certainly takes several years before those two production areas are connected and additional capacity can be sent to China.
Yeah.
Okay. There's a question on the plan also on infrastructures, where it says that yesterday was announced the EU will provide 100,000 million euro destined to build infrastructures and pipelines. Where do you think this money should be applied? What are from your view Europe's most needed infrastructures?
Good question.
Well, that's a very good question. My understanding is that the Commission has earmarked a budget of 210, if I'm not mistaken, billion euros for the REPowerEU project, but there's about 10 billion euros which are earmarked for investment in additional gas infrastructure, which are mainly aiming at debottlenecking capacity, being able to reverse flows, especially from west to east, to unlock markets which are more dependent on Russian gas than others, and also allow for those additional LNG capacities to be delivered. But the bulk of the financing comes to energy supply diversification, so electrification, development of renewables, and also on the demand side to accelerate the energy efficiency target to 2030. I think that there's also, in terms of gas, there's also a more ambitious target in terms of developing biomethane, which is also an alternative to have European produced gas against fossil imported gas. Also more ambitious targets for hydrogen, both domestic hydrogen and imported hydrogen by 2030.
Okay, another question concerning the REPowerEU plan. From your view, what's the hardest part to achieve? Say the measures that have to do with diversifying supply, or the ones more related to demand? And if you think that the plan is realistic?
Well, the plan is ambitious, but the situation is quite extraordinary. So I guess that bold measures have to be taken. In terms of what is easier and what is more complex, that's a bit of a difficult to estimate. I think that so far, Europe has been very successful on the supply side of diversification. It comes at a cost, of course, because Europeans are paying their gas higher than other customers. And this is because of this premium in Europe that Europe's been able to attract additional supply, but there are some limits, as I mentioned, in terms of global LNG capacity. I think that has been highlighted both by the Commission and the IEA in its plan. There's a lot of changes also coming from the consumption side. So in terms of efficiency, in terms of electrification, in terms of changing behaviors, and this requires investment that will not come as quick as a pace as just switching from importing more LNG. So I guess that this also entails some difficulties in mobilizing investment, rolling out all the measures that need to be implemented to accelerate energy efficiency. But this is really a question of both supply reaction and demand reaction to be able to meet those objectives of the plan.
Okay, thank you very much, Jean-Baptiste. Back to you, Arcadio.
Okay, thank you, Jean-Baptiste, for your presentation. I think, are you thinking IEA to deliver new reports or something like this about this? Because now you are active in this area, no? Each 3 months you will have another report about this soon.
Well, on the gas markets, yeah, it's now a quarterly publication, so our next report will be coming out in July.
In July, okay. Maybe we can show to the people here because it will be in the center of the market right now. Thank you very much, Jean-Baptiste, for coming or for doing that on Zoom. It was a pleasure having you here, and you are invited to come here to deliver that because we are open since I think 1 month ago, more or less. Thank you very much. Buenos días a todos y muchas gracias, Jean-Baptiste, por la presentación y por la exposición. Muchas gracias.
Thank you.
Buenos días. Thank you very much.
Thanks a lot. Muchas gracias.
Bye bye.